Crypto investors are panicking after the market took a dip late last week on the back of some higher than expected inflation data. This is going to cause the Fed to be less likely to cut rates in September, but I'm not concerned. I'm still buying, I'm still max long. In this video, I'm going to break down what that data was, why it's got the market so spooked, but why I have never been more convicted. If that sounds good, hit the like and subscribe down below. Give me 10 minutes and we're going to break this down for you. Now, earlier last week, the markets were actually feeling pretty good off the back of some lower than expected CPI data, that's Consumer Price Index. That's how much money consumers, average retail consumers, are spending on goods and services. This came in below expectations and it caused the markets to go up, sending the chances of a Fed rate hike to 100%. But the data that we got on Thursday painted a bit of a different picture. What we saw on Thursday was the Producer Price Index, PPI. This is the amount that producers are paying, and it represents the amount paid on the very first stage of goods and services making their way into the economy. This came in way above expectations, reigniting concerns that inflation from tariffs is actually starting to come up in the data. Now, this has been the Fed's primary concern and the reason why they haven't been cutting rates. They're concerned that tariffs are going to cause inflation and are going to cause their mandate to be difficult to achieve. They want a 2% inflation target, but they're sitting at about 3%. So let's go ahead and take a look at some of this PPI data that came in. On your screen, we're seeing actual versus expected, and then here's the difference. Big miss. We call this a miss. This is a big miss to the upside, and this is not what markets want to see. This reignites concerns that the Fed might not cut rates in September. But the good news is that there's actually more to this story than meets the eye. So getting into the data just a little bit, on your screen we've got the different components that break down PPI, and we can see here that the main driver of the high PPI print was actually services here in blue. But what does this actually mean? On your screen, I've got Stephanie Link, Chief Investment Strategist at Hightower Advisors. She's going to break down what this means, and then we're going to get into it.
PPI, obviously not a good number yesterday, very sticky, but a lot of that was portfolio management fees up 5.8%, and maybe the trade services strength, maybe that's a one-time thing or two-time thing. So I think what was interesting, Joe, is after the numbers this week, the probability of the Fed still cutting 25 basis points in September is still 94%.
And so what Stephanie is saying is that the rise in PPI contributed mostly from services, was primarily from portfolio management and securities brokerage. What this is from? This is based on the overall strength of the stock market. So when the stock market rises, the price to manage those portfolio increases because it's based on a percentage of the portfolio you're managing. And so you could make the argument that the path to rate cuts would largely go unaffected because what we're seeing is actually the result of the stock market doing better. It's not necessarily because of tariff inflation. Now, some of it, yes, was tariff inflation, but a significant part of it was from portfolio management that was as a result of the stock market going higher. And so when I'm thinking about this, I say to myself, what is the likely rate cut path? Because that's what's important. That's why the market sold off. The market sold off because we went from a 100% chance of rates being cut, and it actually brought it down about 10%. So have a look on your screen here. This is the probability of 50 basis points of cuts. This is the probability of 25 basis points of cuts. And this is the probability of no cuts at all. Now, before we saw the PPI numbers come out on Thursday, there is a 94.3% chance. I know I said 100, but 94.3 is basically 100. Plus, there were some groups that were calling for 100%, but we don't have to worry about that. What's 6% among friends? Anyways, so what we're looking at now is a 92% chance. So not a very strong difference at all. Markets sold off in anticipation of the lowering of rate cuts, but when you actually look at what happened in the broader market, because crypto is very volatile. So we saw a dip in crypto markets, but the rest of the stock market was relatively flat. Here I've got Tom Lee. He's going to break this down for you, and let's hear him out. 30 seconds.
I think that the arguments and elements for a rally to continue are in place, because even today, with a hot PPI print, the stock market is basically flat. So we had a down open. I think investors bought that dip. Part of it is I don't think that the PPI is sending a message that inflation's soaring. There are some things to sort of sort of cut out of that number.
And so in that interview, you heard Tom Lee say that there are some things to cut out of that number. I believe he's referring to the services and the portfolio management fees that drove PPI up higher. I can't be for sure, but something tells me that's what he means. And so we have multiple experts talking about these different components that make up PPI. Not all inflation is created equal. We're not seeing tariff-driven inflation. We're seeing services-driven inflation as a result of the stock market going higher. And so this is why I'm still very confident that we'll get rate cuts and why I'm not worried about PPI at all. And the reason why I'm so excited about the prospect of more rate cuts is because more rate cuts means more liquidity. As we reduce the cost of borrowing, we increase liquidity that comes into the markets. And we also encourage people to spend more money on riskier assets. As the fixed income investments come down, as you go from 4.5% to 4% to 3.5% to 3%, people go into riskier assets. Global M2 rises and risk assets perform much better. Have a look at your screen. What we're looking at is Bitcoin over the M2 supply. And we can see, and this is something that we know, right? As M2 rises, so too does the price of Bitcoin. And this is how it happens. And as more liquidity comes into markets, and the further along we get in this cycle, that takes us one step closer to alt season. And I think we all know how that works. The path to alt season goes from Bitcoin to Ethereum to large caps, and then down to mid caps, low caps, micro caps. And this is how it happens. And it begins with rate cuts. It begins with the easing of monetary conditions. It begins with the easing coming from the central banks, allowing for more money to flow into risk assets. And the more that we cut, the riskier we get. That's the path. And that's what makes me just so bullish about the rate cuts that are coming. I am very confident that those cuts are going to be coming in September. It's not only because of the 92% chance, but it's just because the Fed needs to cut rates. It would be a tremendous policy mistake for them not to do so. So I got a brief clip here from Darius Dale, one of the best macro analysts in the world. He's going to break down why he believes the Fed not cutting rate would be a tremendous policy mistake. 30 seconds, check it out.
I don't even care what the inflation numbers are. That is a policy mistake, especially in the context of the worst part of the U-shaped economy that we've been calling for. We are now in the worst part of the U, which is the bottom left side of the U. And so we need policy support to both shore up confidence among investors, but also to shore up confidence among business builders and employers like myself that, hey, we can actually ride our way through this rough patch that's caused by the advent of this tariff shock. It's not a durable shock. It's just a, change that's going to cause a lot of, problems and one-time price adjustments across various sectors of the economy. And you need the Fed to play ball in order to ride us through, to help us ride through that. And so in our opinion, you see some volatility if they do not.
And so there you have it. It would be a massive blunder for the Fed not to cut rates in September. Aside from the fact that two Fed governors, some of the people who actually vote on rate cuts, dissented at the meeting. Their argument was that the Fed should have cut 25 basis points in July. And if you want to learn more about that, check out our last video. We break down the dissent of the other two Fed governors. It's going to let you know why they did so and what you can look forward to at the next meeting. And so if you want to learn more about the Federal Reserve, crypto markets, and the overall macro components that influence asset prices, make sure you subscribe to the channel below. Give the video a like. We really appreciate your support. And leave a comment down below. Let me know what you've learned. Our main goal at this channel is to educate people and help them become better investors so they can retire on time and comfortably. It means a lot to me, and hopefully it means a lot to you as well. We'll see you in the next video. Thanks for tuning in.